Hey everyone, welcome back to another learning session. Today we are going to go through how a call works on your farm. And as always, it's going to be a practical guide of using call options as a risk management tool for ag producers, right? So everything that SimpleHedge does in these learning sessions is always going to be focused around how an ag producer should be perceiving it and deal with it. So let's dive in. So understanding call options, right? Right to the basics. So what is a call option? A call option is the right but not the obligation to buy the underlying asset. In our cases, it'll be futures contracts at a predetermined price, that is the strike price, by a specified expiration date. So, how do the call options move in value? So, a call option increases in value when the price of the underlying futures contract rises. You're essentially buying exposure to upward price movement, right? So, what's nice about the call options is they are a cost effective strategy to give you exposure back to the market without committing to full futures positions or physical purchases. So, for farm managers who've already sold their production, but you may see a potential for price rallies, call options offer that second chance to participate in these favorable market outlooks. And it's without the complexity of going out and trying to buy physical maybe from someone else, or going out and trying to buy physical contracts back from your previous sales. So how does a call work on the farm, right? So let's get into the real world scenario. So again, let's think about this. You're in November and bean harvest is complete. So you delivered all of your production to the elevator and locked in your sale to the buyer. So you've got your cash in hand, your bins are completely empty, and essentially for you, the season is relatively wrapped up. But then you start to look, you can still continue to follow the market, and you're seeing maybe some market signals that are starting to shift. News of tighter supplies, weather issues in South America, maybe export demand is picking up. So you think that there's actually going to be more upside ahead and beans could really rally. But the problem is you've sold everything, all of your physical. And the reason maybe you sold it was you needed the space, you needed some cash flow. Who knows, but you did it, right? So the traditional problem, as we like to highlight, is in the past, as an old farm saying goes, you're shit out of luck once you've sold all your physical. And so traditionally, you wouldn't be able to participate in any rally because you no longer own the physical grain anymore and you already sold it. Buying back your contract from the elevator is very unlikely, and if it is somewhat likely, it comes with some very punitive penalties and complications. So the SimpleHedge solution. Now with SimpleHedge, you can actually easily and accessibly enter into a call option that you can regain market exposure without having to face those punitive penalties of trying to buy back in or trying to buy physical grain from a neighbor or someone else. So you can get back in the game without having to reverse your original sale and deal with those complexities or of a contract buyback, which again, once you've sold it and you've delivered, or you've even delivered part of it, the likelihood of a contract buyback is very slim. A part of the punitive financial penalties that you would get on it, you might also just get the buyer saying, I don't want to deal with this. We're doing it this one time, or we're not doing it at all and never really want to deal with you again. So let's think about this in an example. So let's go through this. So executing this call option strategy. So you go into your SimpleHedge app and you're looking at wanting to capitalize on the potential upside of the market after you've already your physical. So you check the current market prices. You see soybeans are trading at $11 a bushel. Based off of your, we'll say, market analysis, your instinct is you think that the price can rally and you think that it could get up to $11.50 in the coming weeks. So you want to be able to participate, but you already sold your physical. So essentially, you're out of the game, but you're looking at these call options as another way to get that exposure and participate on the upside. So to keep your option cost lower, you may choose to look at a strike price that's slightly away from the current market price. So let's look at 11.25 strike price. This will give you a good balance between the affordability and profit potential if the market proves you to be correct and it gets to the 11.50. So again, now we have to determine what the volume is. So you look back and say, nah, I wish I only sold actually 50% of my total soybean production. So you want to get 50% exposure back. So you purchase the number of call options that it equates to 15% of the bushels you already delivered. So this will give you the meaningful exposure without overextending your risk, if you think about it like that. So you hit select, you trade the call option, boom, you've regained exposure back to the market. So you're now positioned to benefit if soybeans rally as you're anticipating, and this is all without having to reverse your sale or tying up really significant capital. So you've gained that exposure back to the market. If prices rise to your target or beyond, that call option increases in value, and it's allowing you to have participated in the rally you otherwise would have missed. Or we can think about it, you traditionally would have missed if there weren't for solutions like SimpleHedge. So on the left here, we've got our graph. So if we look at this, your $11.25 call. So as you can see, your strike price is here at $11.25. So as the price goes up, your call option increases in significant value and gives you that full exposure. Now, if the price goes down, all you lose is the option premium, which is this spread between the dotted line and the green line, right? So if you get up to that 11.50 here, you are very profitable, way more than you would have been, as we have the dotted line if you had some physical all the way through. So that's what we kind of show up here, and this is pulled right from the app that is taking in your physical and your costs. So if we had a call option and we still had some physical, we would be up an extra $30 an acre with the trade, and without, it'd only be $80. So it's in this situation, if we had our physical, it's basically adding leverage to that situation of going from saying 100,000 bushels to 120,000, right? But the same concept applies in this hockey stick graph that increases as the price goes up if you are just naked on a call option, if you just strictly own that call option. So why call options are actually powerful for farm risk management. So we know put options are the ultimate or hedging for a true risk management for a farm operation, right? But how can call options actually fit into the risk management? So think about this for some strategic advantages. So as we talked about, you can regain market participation. By buying call options, you can get back in the market and position to benefit from price rallies. This is even after you've sold your physical grain. You can still maintain upside potential without the headaches of contract reversals or any of those penalties trying to get that back. So you can still participate on the upside, get back in the market, even though you don't have any more physical. So in a way, you can also think about this, that if I produce 100,000 bushels of soybeans and I sold 100,000, I can still trade another 100,000. It would be like I have 200,000 bushels or produced 200,000 and only sold 100,000. Right? So you can really leverage up what your bushels are, or your theoretical production. Flexible, low capital commitment. So compared to buying futures contracts or the physical grain contracts, the call options only require the premium payment up front. So they are considered a more cost-effective strategy than the futures outright. You cap your downside risk, which is just the cost of the option that you pay, but you get that full upside, unlimited upside potential rallies. The other one is, and this is a really good one, especially for people that, sometimes feel that they're forced to sell at harvest for cash flow or storage needs. So engaging in a call option can be a really good hedge against your future input costs. So your future input costs are generally correlated to what commodity prices are. So if you sold early for that cash flow or storage needs, but prices continue to rise, your next year's seed, fertilizer, and chemical costs may also increase. So what happens is that you've then sold at this one price, prices have gone up further, and your future inputs are also going to potentially be matching to that. So then all of a sudden you found yourself not keeping pace with the market and slightly out. So that's where you can then engage in a call option, which will help you keep pace with the market and give you the gains that can help offset some of those higher input expenses that may occur down the road. So for producers who sold earlier than ideal, whether due to the storage limitations, immediate cash needs, or other operational reasons, the call option will provide a practical path to stay connected to favorable market movements throughout the crop year. And that is a really key, to stay connected to favorable market movements. That's our call option presentation today. Appreciate you joining in. My name's Steven. You can contact me, steven@simplehedge.com. Give us a call at our US or Canada number. We appreciate any and all feedback or discussion. And as always, follow us on our socials at X and Instagram below. Thanks very much.